thank you to GCM Grosvenor and Resolute Investment Managers Inc. for sponsoring Series 3 of 2025. GCM Grosvenor is a global alternative asset management firm with a long-standing commitment to supporting small, emerging and diverse investment managers. For over 30 years, the firm has developed expertise in funding and guiding these managers as part of its broader activity across alternative investments. With over 20 billion in assets under management dedicated to small and emerging managers and 16 billion in assets under management dedicated to diverse managers, GCM Grosvenor leverages its experienced team, broad network and proprietary sourcing capabilities to support their success. Through the Small, Emerging and Diverse Manager Programme, the firm creates opportunities for investors to access a wide range of talent while seeking to drive strong returns and impact. Resolute Investment Managers Inc. is a diversified multi-affiliate asset management platform that partners with over 30 best-in-class affiliated and independent investment managers. Its unique platform delivers strategic value through a full suite of distribution, operational, and administrative services available to affiliates and partners.
Don't be too afraid to make mistakes. This industry, I think, attracts a lot of type A personalities and people that can have a hard time accepting anything that's less than perfect. And I think I put myself in that category, but mistakes do provide these important opportunities for growth. And I think really lasting lessons that help shape you as a person, as an investor, and as a team, as an investment team at Evanston. We often talk about how only making the safe decisions or investing with the crowd likely isn't the way to, generate distinguished results.
I'm Aoife Devitt, and welcome to the 50 Faces podcast, a podcast that showcases inspiring professionals in the world of investment and beyond by focusing on people and their stories. I'm joined today by Kristen Van Gelder, who is Partner and Co-CIO at Evanston Capital Management. Evanston Capital Management builds multi-manager portfolios in the hedge fund area and manages over $4 billion in assets under management. It is based in Evanston, Illinois. She's spent her entire career since college at Evanston. Welcome, Kristen. Thanks for joining me today.
Thanks so much for having me.
Well, let's start by talking about your career journey before Evanston. And can you go back to what you studied and where you grew up?
Yeah. So growing up, I was always a numbers person. I really loved math, loved figuring out puzzles. And I also thought that was my strongest skill set. So I applied to colleges thinking I would be a math major, but my parents kind of questioned what career I might apply that degree to. And they encouraged me to find a major where I could, maybe apply math to more of the real world or to the social sciences. So following their advice, I ended up majoring in economics. That was a pretty large undergraduate program at Northwestern where I studied. And I think it was also a bit of a catch-all for students like me who still didn't know what they wanted to do with the rest of their life after college. So I graduated in 2003. At that time, I still didn't really have a firm idea of the job that I wanted. I explored opportunities primarily in consulting and in finance. And I think it was mostly because I thought that was the most natural fit for my degree, as opposed to, knowing a whole lot about careers in either of those industries. And in that search, I was lucky enough to come across a listing for an entry-level investment analyst position at Evanston Capital. At that time, Evanston's business was still very nascent. They had just gotten going in 2002. I think the firm had $80 million under management at the time. And it was just the four founders. They were looking for their first hire. I did not know the first thing about hedge funds, but I was lucky enough that they took a chance on me. And I think I was attracted to the opportunity because I'd had a prior experience working in a smaller, more entrepreneurial environment and a prior summer job. It was in a completely unrelated field. It was for a small software company. But I was really attracted to that dynamic. I felt like I could see a lot more of my impact on an ultimate project or something at the firm in a small setting like that than I could at large organizations. And I also thought, even if I didn't end up loving this world of asset management, this world of hedge funds, if nothing else, I thought I would learn a ton working so closely with the four founders of the business. So, as a small organization, initially, we all wore many different hats. And early on, I got exposed to multiple different facets of our business, which was super neat. I got to do stuff in client service, accounting, operations. My core responsibilities, though, were always focused on centered around investment research. And then as the firm grew and we built out our team, we all were increasingly able to specialize on, our own functional areas. And so really after the first several years, and even to this day, the majority of my time is focused on the investment process. And I'd say also the changes in my role and responsibilities over, 2+ decades, it was really gradual and consistent. It happened, I think, really naturally and almost organically. I kind of describe it, as a parent seeing your child day in and day out. You sometimes don't notice how much they've grown. And then there's someone that hasn't seen them in 3 months and they're all like blown away by how much they've changed. It was like being in it every day. Like the little changes were almost imperceptible to me, but I was kind of growing and changing over that time. And I think if I look back, there were probably a couple bigger stepping stones in my career. And funnily enough, they each occurred about 7 or 8 years apart. The first came in 2010 when I became a member of our investment committee. And I think to me, that was really kind of a signal that I was contributing individually in a meaningful way to our investment process. And it also gave me this boost of confidence to kind of continue finding my voice. And then the second was when I became deputy CIO in 2018. And I think that was really a time frame where I started to take on even more of a leadership role, both internally and externally.
And congratulations on the recent promotion to co-CIO, which we announced.
Thank you. Yeah, that was just earlier this year.
Very hot off the press. But just before we move into the world of hedge funds and discuss that a little bit, because I think it's been a fascinating evolution of that world, just give us a minute on the roots of Evanston Capital Management, because it had its roots in Northwestern originally, right? There was some connection between Northwestern Endowment and that.
That's right. Yes. One of our 4 original founders, David Wagner, was the former chief investment officer of Northwestern University's Endowment. He was there for about a decade. Believe it or not, when he arrived at the university, it was a very traditional portfolio. I mean, it was primarily stocks, bonds, cash. So he kind of spearheaded and led the university into the world of alternatives. A big component of that, hedge funds. He himself learned the discipline of hedge funds first by investing in a fund of funds model like Evanston. And over time, they had the staff and the resources where they really could build their own direct portfolio. But he founded Evanston with the vision that, hey, there are a lot of smaller institutional investors that probably will never make that leap. And he wanted to bring that endowment-like approach of investing in this asset class to external investors. So that's really the history and the lineage.
And I think my own contact with Evanston goes right back to those early years, around about 2002, 2004, which is when I was at Cambridge Associates. So a very strong alignment of investment philosophy certainly there. And now moving into the world of hedge funds. So, 2 decades clearly since those early days, and the landscape of hedge funds looks quite different, I'm sure. I'd love to focus on today what excites you, because some investors may have kind of written it off, this area of hedge funds, or moved on. There are other perhaps shinier objects on the landscape now. But I'd love to hear what excites you about the hedge fund today and how you would assess the lie of the land.
Yeah, I think hedge funds are very much back in the conversation today. I think it's because, the last several years we've just been in a very different environment, and diversification and downside protection have become, even more of a priority for investors. I contrast that to the decade following the global financial crisis, where things looked a lot different. You had interest rates globally pinned near zero. You had markets generally going up and to the right. You had volatility fairly low and correlations relatively stable. And I think that environment, as you rightly point out, favored stuff that maybe wasn't hedge funds. It favored passive, long-only strategies. I think it also favored longer duration strategies like private equity and venture capital. But I think the environment today is so much different. You have a meaningful cost of capital. There is a lot of uncertainty in terms of the macroeconomic backdrop. You have much higher market volatility and you have less stable cross-asset correlations. So I think that's a backdrop that very much favors active management, and the flexibility of the hedge fund mandate in particular And I think it also likely favors alpha over beta. So I think I see a really rich array of opportunities across hedge funds. If we look at the strategies that we're probably the most excited about today, I would highlight both long short equity and global macro strategies. So within long short equity, these strategies, I think for a while have been benefiting from much greater dispersion between individual stocks. And that's something that these strategies really thrive upon. You're really generating your results by generating a spread between your long and short investments. So you need dispersion in the market to generate great results. And I think the higher dispersion is partly due to the fact that we have higher rates. That's causing more discernment between individual companies on a fundamental basis. Factors like their return on invested capital, their ability to service their debt loads, et cetera. But I think it's also been driven by just a higher degree of change, both at the macro and industry levels. So if we just take tariffs, for example, trade policy really could have huge implications for different sectors and individual companies. And there are some that have a lot of pricing power. They have a lot of flexibility within their supply chains to handle tariffs. And then there's others that are in much weaker positions. So I think, that leads to more long and short opportunities. And then at the industry level, you see a bunch of different themes. Just taking, for example, the ongoing innovation and early adoption within AI, that can lead to a lot of productivity gains for the companies that are able to effectively harness it. And likewise might leave behind the companies that aren't so able to do that. So we think it leads to a lot of winners and losers, not just within the tech sector, but across the economy more broadly. At the same time, we think actually levels of competition in fundamental long short equity, especially for managers with more medium term, call it multi-year investment horizons. To us, that level of competition seems like the lowest it's been in many, many years. We all know about the trend toward passive long only strategies and equities. But even within active management, I would say that a lot of the capital has flowed into much shorter term, more trading oriented strategies. And then we see definitely far less competition on the short side of portfolios. There are so many managers that just threw in the towel on shorting after years of the market just kind of steadily rising. And then even for those that stuck with shorting, we saw this trend of moving toward blunter instruments like index futures and ETFs and away from individual stock shorting. And that trend really accelerated, I would say, in early 2021 when we saw that crazy kind of meme stock phenomenon and a big short squeeze. So I think for us, we see this big opportunity for a long short, much less competition. And then particularly for those that have the skill and the disposition for short selling. And then if I could make some comments too on global macro, I think we're just simply in a more macro world today. Under a second Trump presidency, this new administration obviously seems very intent on shaking up established policies. And we've already seen big shifts and U-turns with respect to proposed tariffs and the potential trade deals. And, that it's going to mean a lot for ultimate macroeconomic conditions like inflation, growth, monetary policy. I think, moreover, it just seems that these trends toward deglobalization and trade protectionism, it's driving us toward a less interconnected world. And we think that creates the chance or a higher chance for more varied economic conditions and different central bank policy actions in individual countries and regions around the globe. Like you contrast that with prior years where global monetary policy was very highly coordinated. So we just think that creates a much more diverse and rich set of trading opportunities for macro managers.
This is fascinating because I started my career in hedge funds in '02, as I said. So I could speak about this all day because I think, you've seen such shifts in the industry. And later in the podcast, we'll talk about your own kind of lessons learned. But I'd like to ask whether you've any insight into the industry's lessons learned with some of this, the change you've seen. You mentioned short selling, many threw in the towel. Has there been any changes, I suppose, in the shape of the industry? Is it more concentrated today? Have the bigger managers continued to get bigger and have more pricing power when it comes to fees? Are there people emerging today as new hedge funds? And then finally, I'm going to squeeze in one more, trend following. What is this market like for trend followers?
Yeah, so I think the big trend, obviously, in hedge funds has just been the overall institutionalization of the industry. We've been going through that for decades. Investors have very different expectations for hedge funds today than they did 20 years ago. Gone are the days of a couple people with Bloombergs and a 2 and 20 fee structure as market standard. Investors expect a much more developed business and operational infrastructure. They expect greater levels of transparency, much more alignment and investor-friendly fees and terms. I think that in particular, there's been a rising concept of hurdle rates and performance fees, especially with the increase in interest rates in recent years. That's been something that we've advocated for with our managers. I think hedge fund investors are very happy to pay for superior performance. They're less happy to pay for mediocre results. And certainly if, a manager is just earning the cash rate or something near it. So those have been big topics. I do think that you've seen the big getting bigger. And one trend that we've seen is just explosive growth within the multi-portfolio manager or pod shops in recent years. We think that create some increasing risks for the industry. There is a lot of commonality across those investment strategies. There's definitely a lot of commonality in the risk frameworks that they use and the risk constraints that they operate within. They usually have very tight drawdown controls that would lead to de-risking or deleveraging. They operate with high degrees of leverage. And with all of their growth, they just command such a large collective asset base, and they've become a really large share of the daily trading volume. So we think that this is one risk potentially that could be overlooked as an industry, especially if, we're in this, what seems to us to be an environment where we're sort of unusually ripe for change. So assuming like the same usual world or the same historical correlations or relationships between assets we think could be dangerous, especially for the most highly leveraged hedge fund strategies that really rely on backward-looking risk models to give them a lot of confidence in their ability to operate at those high levels of leverage. So we think that's maybe a little bit of a risk that the hedge fund industry is underestimating, just increases the potential maybe for contagion among those strategies that have grown so large. At the same time, I think their trading does create a lot more short-term dislocations among individual securities. So we think that investors that do have a longer-term investment horizon can kind of take advantage of those shorter-term price moves and, profit from them over time.
So interesting. And then when you speak about the investor demand and the investor kind of use case for hedge funds, I think that's probably evolved too. In recent years, I've seen it be more of a fixed income substitute at times. Definitely originally a defensive hedge in the portfolio. Have you seen it evolve in terms of how hedge funds such as those offered by Evanston or fund of fund solutions are used in a portfolio and how investors think about them?
Yeah, I think, the hedge fund universe, there's so many different strategies and styles. It really isn't a single monolithic asset class. And I think investors use them in very different ways in their portfolio. But I think today, still the most common use is as a diversifier or as potentially, as you outline, a bond substitute. And I think that's especially true in today's environment. Investor needs in hedge funds is really for that downside protection, for that reduction in volatility in their overall portfolio, because, as I alluded to earlier, we've been in sort of a new regime in terms of the diversification between stocks and bonds. I think bonds have become a less stable diversifier given the ongoing concerns about inflation and fiscal deficits. We saw this as recently as April when equities were selling off very hard and bonds didn't play their usual role as safe haven in portfolios. So I think that really opens the door for the need for other sources of diversification, something to protect your downside and reduce volatility. And I think, that's what hedge funds offer and what investors are most looking for from their role in hedge funds today. And I'd contrast that with some other alternatives like private equity, private credit. Those are alternate forms of beta. They come with them as well, some alpha, but they're still long only risk on strategies, right? I think the reduction in volatility they offer primarily comes from the underlying assets liquidity profile and the fact that they're marked on a lagged or quarterly basis. They're not truly uncorrelated to kind of economic fundamentals.
And my final question then, just about strategies, is some of these emerging asset classes, if you call it that, or assets in their own right, whether it be Bitcoin or gold or sometimes pure play commodities or energy, some investors may feel uncomfortable getting exposure directly. To what extent do hedge funds offer conduits to some of these more exotic assets?
Yeah, I think it's always been a space where hedge funds are kind of the ultimate flexible investment vehicle, right? So as new assets emerge, hedge funds are probably the first to kind of start to take advantage. I'd say we have stepped very carefully into new areas. And when we go into something that's truly emerging from an asset class perspective, we view it as, maybe opportunistic or tactical, and it would be a smaller position in our portfolios. But I do think that emerging talent in hedge funds is a super important source of alpha. So not so much brand new asset classes, but brand new managers that are starting their businesses. They've likely proven their success at another firm that, you may know well, but they're transitioning from becoming an analyst to a portfolio manager. We're big believers that the typical hedge fund has a natural life cycle. And there's a lot of value from identifying and investing in that talent early when the manager is smaller, when they have a very wide opportunity set, a lot of trading flexibility, when they're usually hungrier and more motivated, and when also their incentives are most aligned around performance. That's always been a big emphasis for us.
Some investors around the world in particular are looking to invest sustainably, with a sustainable overlay, perhaps, or certainly with what used to be called ESG criteria, maybe a slightly modified term now, really
Sure.
as part of the risk management process. To what extent can hedge funds fit any of the bill here, or do they even try?
Yeah, I think it's still a really pretty complex issue of how to measure and manage investment exposures to align with sustainability goals, right? We have a couple different approaches. There are exclusionary approaches, right, that avoid investing in the quote unquote bad companies. You have the inclusionary approaches that emphasize overweighting the good companies. But I think both are still based upon relatively subjective determinations and ESG ratings that they are themselves imperfect. And then when you look at hedge funds specifically, I also don't think we've reached a consensus yet about the right way to measure exposure to sustainability factors within the hedge fund context, right? Because hedge funds can also sell short securities. So what's the right measure? Should it be gross exposure to these factors? Should it be long exposure? Should it be net exposure? Like, do we give a manager any credit for being short the bad companies? I think that's a question that's still out there. So for us, when we're thinking about the issues of sustainability, rather than trying to force these kind of strict definitions upon our managers, we're more focused on how they can take these issues of sustainability and turn them into a potential source of opportunity for them, as potential source of returns. We think that energy transition is going to be a really enduring theme, probably for many, many years. And that'll drive a lot of change and disruption. And that's often the most fertile ground for alpha generation. So we've already seen it as a theme among hedge fund manager portfolios, among some of our own managers' portfolios. And I think if managers can identify and buy companies that are bringing solutions to sustainability problems, and short companies that are doing the opposite, the hedge fund industry has a chance at both, generating some pretty interesting returns from that, but then also hopefully contributing in some small way to some positive change.
That's a very hopeful note, I think, to answer that question on. So thank you for that. And just a sort of subset of that question, and it's because you've been in the industry for 2 decades, as we discussed, and you, I'm sure, have seen some change, whether it's around representation in rooms, the emergence of some wonderful industry groups such as Women in Private Credit, and just many other groups. Diversity of the industry representing the people it serves. Any grade you would give it? Any comments you can make?
I would say the industry has made a lot of strides, certainly since I first started, and especially among the allocator community, people that sit in a seat like mine investing in external managers. Anecdotally, I was just recently at a big industry conference, and I think about 25% to 30% of the attendees in my roundtable discussions over the course of the day were women and minorities. And I'm not sure what that stat would have been 20 years ago, but I'm very confident it would have been meaningfully lower. So I think there's still a lot of work to do. I mean, I personally would love to see more women and minorities in investing roles, and in particular as founders and portfolio managers of hedge funds. And I think that there is, as you mentioned, some great organizations that have emerged to kind of help us as an industry make progress, continue working towards these goals. And I think there's probably a couple ways that we can continue improving, most importantly. And the first is just making an effort to seek out a larger set of qualified candidates in the, hiring and recruitment phase. That I think is easier said than done. It takes a lot of effort. And I think some of it will start with more education and counseling at the high school and college levels. I mean, obviously, I didn't know much about this world, really only stumbled upon it and got lucky. So that I think is one way that we can kind of continue to improve as an industry. And then I think second is continuing to emphasize, but also finding ways to reward mentorship and development of employees. I just think that's so important to helping people early in their career, just feel like a valued team member, but then also creating a culture where these differences in perspectives are embraced and, more importantly, really understood to improve our decision making.
That's a really interesting point. I think we speak a lot about mentorship, but forget that sometimes the mentors are still themselves focused on their own career progression. So
Right.
if they're not getting recognized for the work they do downstream, then there's less incentive to do it, even though there is a good rewarding aspect to doing it. And that really lies with leadership then, to actually have that trickle down mentorship, I suppose, mantra or mentorship mission, which is so interesting. So thank you for pointing that out. I'd love to move now to some personal reflections. So I've asked you to discuss the industry lessons learned. Any lessons learned of your own throughout the course of your career, whether it's through investment mistakes or ups and downs or just setbacks or challenges?
Yeah. I would say, honestly, like my number one thing is don't be too afraid to make mistakes. This industry, I think, attracts a lot of type A personalities and people that can have a hard time accepting anything that's less than perfect. And I think I put myself in that category, but mistakes do provide these important opportunities for growth. And I think really lasting lessons that help shape you as a person, as an investor, and as a team, as an investment team. At Evanston, we often talk about how only making the safe decisions or investing with the crowd likely isn't the way to, generate distinguished results. So you do need to take some risks to make returns. They should be carefully calculated risks, of course, but you need to trust in your process and in your work to come to conclusions, that might not be the consensus. And, I think that I was really lucky to grow up in a firm that they provided me some space to make those mistakes, especially feeling out my way, the way I could be the most effective manager and leader. I've worked at Evanston my entire career, so I didn't have a lot of other models that I could follow. I kind of needed to learn a little bit by trial and error. And, I always had the support of my colleagues to kind of give me that space to figure it out.
Well, that's a great shout out to those colleagues. And my next question was around any key people who were mentors or motivators to you. Maybe it's the same people, but if anybody you can list there.
Yeah, no, I mean, there's a lot, but, professionally, I think the two biggest influences on me have been Adam Blitz, who is our CEO and co-CIO. I've worked with him for almost 22 years now. And Don Fairs, who was a former partner on an investment team. And I worked with him from 2006 to 2020 when he retired. And I really owe much of almost everything of what I know about hedge funds and about investing to them. They really helped shape my philosophy and my approach. And it wasn't a formal mentorship per se, but I just learned from their example daily over many, many years. And I believe the hedge fund industry is absolutely an apprenticeship industry. It's one that you need to learn by being part of it, by observing a little bit by osmosis, but also by doing and being hands-on. So I'm really fortunate that both Adam and Don guided me along the way, but again, also kind of gave me that space to figure things out and find my own way. I think the level of trust and the degree of autonomy that they gave me over time, it gave me this really great sense of responsibility, and I think pushed me to work harder just to continue justifying their confidence. But I also would say, just in my general life, my biggest role model and influence has absolutely been my sister. I mean, she's 4 years older than me. She's a very successful career in law, and she totally paved the way in terms of academic and professional achievements, and she's just such a strong example for me growing up. So she's still now like the one person I know I can always go to for advice, for encouragement, just, that ear to listen to you or some stress release. So I'm really lucky that I've had her in my life.
That's wonderful. And Adam is certainly one of the pillars of the hedge fund industry. But the slightly disconcerting thing about Adam is he hasn't changed how he looks in 20 years. So it's like he still looks the same as he looked when I first got to know him, which is obviously something in the water up there in Evanston, Illinois. But yeah, an absolute legend. And I think what I've always loved about the Evanston style as well is the transparency. The absence of a black box in terms of how you approach your portfolio construction, how you disclose what's going on in your portfolio and why, attribution. I think it really sets the standards. So, if that's part of the learnings that came through the Adam chain, then absolutely a very exclusive approach to that area. My last question is just around any advice. You've already kind of had some here in these answers, but any kind of last words of wisdom, creed or motto that you can leave us with?
It's funny because just reflecting on creed or motto that I live by, maybe I think I didn't really have a label for it until a few years back. I was watching an episode of Bluey with my kids. I don't know if you're familiar with this show, but it's like an Australian cartoon about a family of dogs, and it's really sweet. It has always I think great life lessons for kids, but it's just as entertaining for adults to watch, especially parents. And there was one episode that ended with this lesson that was basically run your own race. And when the mom said that as the parting words of the episode, I was like, that is kind of the way that I've been trying to live my life, certainly as an adult. Instead of focusing a lot of my time and energy on comparing myself to others or, where they are in their life or their standards, I've really tried to focus instead on what's most important to me and the people that I care about, and just trying to perform my personal best. And I think as a parent, I've also been trying to do the same with my kids, just encouraging them to focus on their individual progress without constantly comparing themselves to their siblings or their friends or their teammates, classmates. And I think all of that can be extremely hard to do in this age of social media. So I'm just hoping that can be a little bit of a lasting influence or message for them once that phase of their life starts to begin. I think hopefully we're at least still just a couple years away from that. But
well, definitely a first time we've quoted Bluey, but just like any episode of Bluey, when you said it, it almost made me cry because I think that is the absolute brilliance of that cartoon. So I'm sure many episodes have made many parents cry. So thank you for those words. And thank you so much, Kristen. That was a very deep tour through the last 2 decades of hedge fund investing. I feel I've had kind of a cliff notes in what happened while I was out of the industry. And thank you for sharing that and for sharing your own journey with us.
Thank you so much for having me. It was a pleasure.
I'm Aoife David. Thank you for listening to the 50 Faces podcast. If you liked what you heard and would like to tune in to hear from more inspiring investment professionals and their journeys, please subscribe on Apple Podcasts or wherever you get your podcasts. This podcast is for informational purposes only and should not be construed as investment advice, and all views are personal and should not be attributed to the organizations and affiliations of the host or any guest.